The other category of deferrals that we have spoken about and that we're going to talk about in depth now is unearned revenues. Unearned revenues occurs when you receive cash before you have performed a service. So the obligation has not been satisfied. Therefore, your obligation is then recorded as a liability. You will debit cash and credit the liability unearned revenues. It is when cash is received before the revenue has been recorded or earned. Some common unearned revenues are rent. You pay at the beginning of the month or you pay on the last day of the month before the month it's due. Airline tickets, which we purchase in advance. Magazine or software subscriptions. So if you pay a certain amount for something for a year's use, such as a magazine subscription, you pay $15 to get a magazine every month. Or you pay $150 in order to use a specific program for a year. Either way, the company has received cash, but they've not fulfilled all of the obligations associated with that cash. Many times when you go into a relationship with someone like a builder or a contractor, they say, I need X amount of a deposit when the contract is signed. That customer deposit hasn't been earned by them yet. They have an obligation to fulfill before they have earned those monies. Adjusting entries are made to record the revenue for services that are performed during the period that you're reporting and to reference accurately how much of a liability continues to remain. These adjusting journal entries result in a decrease or a debit to a liability account and an increase or a credit to a revenue account. You are saying, I no longer owe this amount of obligation, and I have fulfilled this amount of service. Looking at them in T accounts, just to reference you in a different type of an illustration, how we decrease the liability account and increase the revenue account when we're adjusting for revenues that have been earned from those monies or those unearned revenues to date. Let's talk about Sierra Corporation again, who received $1,200 on October 2nd from R. Knox for guide services for multi-day trips expected to be completed by December 31st. So the $1,200 is an amount that we have received. We have not yet performed a service obligation on October 2nd, so we recognized it as an unearned revenue. The expectation is somewhere between October 2nd and December 31st, these amounts will be earned. We don't know when, though, at this point. Our unearned service revenue will have a balance of $1,200 with no other adjustments having been made in the October 31st trial balance. Seeing that we had unearned revenue, we go back and we continue to do an evaluation of all the services that we perform to Knox, and we determined that $400 of this money has been earned in the month of October. So we have fulfilled that obligation and will reduce the unearned service revenue liability by $400. And we'll recognize that we actually have earned and performed obligations and services of $400 in this month. When accounting for unearned revenues, they can be any variety of situations where we receive the cash before providing the service. We are making adjustments to recognize the amounts of revenue that are actually earned as those services are performed. And before we engage in our adjusting journal entry, our liabilities are overstated and our revenues are understated. Therefore, to adjust, we need to debit or decrease our liabilities and credit or increase our revenues. So let's just take a second and let you peruse about gift cards. I don't know about you, but they're definitely kind of my go-to nowadays when purchasing things, because we do have now so much more options that a gift card sometimes is the easiest answer. The impact of the gift card is not hugely surprising, as with a gift card, you as a customer have given money, but yet to have had that fulfilled in either a service or a good exchange completion. Gift cards are the epitome of unearned revenue. There continues to be some debate on how gift cards should be recorded. Is it when the gift card's sold? Is it when it's exercised? What about things that expire? There is guidance from GAAP on all of this, but it's one of those things to show you how substantial something like unearned revenue can be for an organization. $406 million of unearned revenue related to gift cards for Best Buy in a recent balance sheet. That is a substantial amount of money. That is a decision impacting amount. I got a little click happy there. So let's do some adjusting entries for deferrals. We have Hammond here on March 31st, 2017. What we have illustrated here is a portion of their trial balance. See the debit and the credit side? This is what you're seeing here is a piece of the trial balance. We recognize that these pieces need adjusting entries. After engaging in the analysis, we go back to the insurance policy. We look at what period it covers, how much it costs, what the expiration rate amount is, and we figure out that insurance is expiring at a rate of $100 per month. We went and we did a count of the supplies to see what's really there, and there's really only 800. We refer back to our depreciation schedule, which you'll learn about more in later classes. And notice that the equipment depreciation is $200 a month. And during March, we actually performed some services of $4,000 worth of unearned service revenue that is currently being reported. So I'll give you just a moment to think about this particular first instance of insurance expiring at the rate of $100 a month. What is insurance? What type of a deferral is this? So we will recognize the expense for the current month, the expiration amount, and that is an insurance expense of $100 per month. And we will reduce our assets, prepaid insurance, by $3,600. No longer will we have $100 worth of coverage left. Now let's look at the supplies on hand. There's $2,800 worth of supplies represented in the books, but there's only $800 on hand. If we know that we actually have $800, then we need to adjust that account to reflect what there currently is. That difference is $2,000. There was $2,800. There's now only $800. Therefore, $2,000 of it was consumed. We recognize that consumption, that expiration, that using up over time, that cost allocation. We go and we create an expense entry. So supplies expense of $2,000. And reduce the amount in our balance sheet to accurately reflect the true balance of what is on hand. By reducing it by $2,000, we will now have only $800 of supplies reflected on the balance sheet. The third instance deals with depreciation. Our depreciation schedule tells us that equipment depreciates at a rate of $200 a month. So we need to cost allocate. We need to recognize that allocation in our depreciation expense. And then we post to the contra account accumulated depreciation equipment, $200. The equipment was beneficial for this month. That is why it is cost allocating into this current period of its useful life. And last but not least is the services that were performed in the month of March. During that month, we actually did complete $4,000 worth of the obligations that had not been completed as of the last balance sheet date. We had $9,200 of unearned service revenue. We had an obligation to provide services in that amount to our customers. We have now fulfilled $4,000 worth of that. Now we only owe our customers $5,200. So we debit unearned service revenue, $4,000, and we credit and recognize the completion of that obligation, a service revenue for $4,000. When you're preparing adjusting entries for accruals, those also will affect both a balance sheet account and an income statement account. We will pause at this juncture and begin talking about our friends, the accruals, at the next video.